Today we're diving deep into a topic that's close to my heart, investing as a student. You see, I started researching investing when I was just 15. I was obsessed with the idea of making my money work for me, even back then. By the time I got to college, I had a decent portfolio going, and I learned a ton about managing my investments while juggling classes, exams, and let's be honest, the occasional late-night pizza run. Now, you might be thinking, Mike, that's easy for you to say. You're like a smart investor guy. And yeah, I get it. But trust me, you don't need a trust fund or a six-figure income to get started. What you really need is the right mindset and a solid strategy. That's why I'm sharing 5 of my top tips for student investors, designed to help you build a strong foundation for your financial future, even if you're starting from scratch. But before we jump into that, are you investing for long-term income and financial freedom? Subscribe now, because I'm here every week sharing the best dividend stocks and investing tips to grow your wealth. Before you even think about picking stocks or opening a brokerage account, you need to ask yourself a fundamental question. Why do you want to invest? This isn't just a casual question, it's the cornerstone of your entire investment strategy. Without a clear purpose, you might find yourself lost in the sea of financial options, unsure of which direction to take. And no, to make money isn't a good enough answer. While making money is a natural goal, it's too vague and doesn't provide the emotional drive you'll need during tough times. We all want to make money, right? But the real question is, what will you do with that money? How will it change your life or the lives of those around you? But what are you really working towards? Is it early retirement? Do you dream of spending your golden years traveling the world? Or perhaps starting a new venture that you've always been passionate about? Financial freedom to pursue your passions? Imagine having the time and resources to fully dedicate yourself to your hobbies, whether it's painting, music, or any other passion project that brings you joy. Leaving a legacy for your family? Perhaps you want to ensure that your loved ones are taken care of, providing them with opportunities and security for generations to come. Understanding your why is crucial because it's going to be your anchor, your motivation when the market gets volatile, and believe me, it will. The stock market is unpredictable, and there will be times when you question your decisions. When you're staring at a sea of red on your portfolio and feeling the urge to panic sell, remembering your why will help you stay the course. It's this deeper purpose that will give you the strength to weather the storm. It's about having a long-term vision and understanding that investing is a marathon, not a sprint. Just like training for a marathon, it requires patience, discipline, and a clear goal. Think of it like training for a marathon. You wouldn't start running without a plan or a reason, would you? Are you running it just to say you did? Or are you running it to prove something to yourself, to raise money for a cause you believe in? Or maybe to finally cross that finish line after years of dreaming about it? Your why gives you the determination to push through the challenges. Your why is your fuel, your driving force. It's what keeps you going when the going gets tough. So take some time to really reflect on what motivates you. This isn't a decision to be rushed, it's something that requires deep thought and introspection. Write it down, visualize it, and keep it at the forefront of your mind throughout your investing journey. By doing so, you'll have a constant reminder of why you started and what you're working towards. Let's face it, we humans aren't exactly wired for rational decision-making, especially when it comes to money. Our brains are complex, and when it comes to finances, they often lead us astray. We're emotional beings, and our emotions can wreak havoc on our investment portfolios if we're not careful. Fear, greed, and anxiety can cloud our judgment, leading to poor financial decisions. You see, our brains are hardwired to avoid losses more than we seek gains. This is a survival mechanism that has helped humans for millennia, but it doesn't serve us well in the financial markets. This is known as loss aversion, and it's a powerful force that can lead us to make irrational decisions, like selling low and buying high, the exact opposite of what you want to do. This behavior can be detrimental to long-term investment success. Then there's the herd mentality, the tendency to follow the crowd, even when it's heading straight for a cliff. This can be seen in market bubbles and crashes where everyone seems to be making the same mistakes. When everyone is buying a particular stock or asset class, it's tempting to jump on the bandwagon, fearing that we'll miss out on the next big thing. This fear of missing out, or FOMO, can lead to overvalued investments and significant losses. But remember, the market is driven by fear and greed, and often, the crowd is wrong. Following the herd can lead to disastrous financial outcomes. To be a successful investor, you need to be aware of these psychological biases and learn how to manage them. Developing a disciplined approach and sticking to a well-thought-out plan can help mitigate these emotional pitfalls. One of my favorite books on this topic is Animal Spirits by George Akerlof and Robert Shiller. It delves into the emotional forces that shape market trends and offers valuable insights into how to avoid common behavioral pitfalls. It delves into the emotional forces that shape market trends and offers valuable insights into how to avoid common behavioral pitfalls. Understanding these concepts can give you a significant edge in the market. Another great read is Your Money and Your Brain by Jason Zweig. This book explores the neuroscience behind our financial decisions and provides practical strategies for overcoming our emotional biases. It explores the neuroscience behind our financial decisions and provides practical strategies for overcoming our emotional biases. By understanding the psychological factors at play, you can make more informed and rational investment choices. Chapter 3. Time is your friend. Building a strategy that fits your schedule. Look, I get it. You're a student. You're busy with classes, exams, maybe a part-time job, and let's not forget about that whole social life thing. Balancing all these responsibilities can be overwhelming, and the last thing you want is to add another time-consuming task to your already packed schedule. You don't have hours to spend every day researching individual stocks or analyzing complex financial statements. The idea of diving deep into financial reports and market trends might seem daunting, especially when you're juggling so many other commitments. And honestly, you don't need to, at least not when you're just starting out. The key is to find a strategy that fits seamlessly into your life, allowing you to invest without feeling overwhelmed or stressed. Instead of trying to be a day trader, spoiler alert, it rarely ends well. Focus on building a simple, time-efficient investment strategy. Day trading requires constant attention and can be incredibly stressful, often leading to more losses than gains. One approach is to invest in low-cost, diversified index funds. These funds are designed to mimic the performance of a specific market index, offering a straightforward way to invest without needing to pick individual stocks. These funds track a specific market index, like the S&P 500, providing you with instant diversification and exposure to a broad range of companies. This means you're spreading your risk across many different stocks, which can help protect your investment. It's like buying a tiny slice of the entire stock market in one go. This way you benefit from the overall growth of the market without having to worry about the performance of individual companies. Another strategy is to use quantitative analysis, which relies on data and algorithms to identify investment opportunities. This method can help you make informed decisions based on statistical evidence rather than gut feelings. There are plenty of online tools and platforms that can help you with this, such as using IFTTT, if this then that, to automate your investments based on specific criteria. Automation can save you time and ensure that you're consistently investing without having to manually manage your portfolio. For example, you could set up an IFTTT applet to automatically invest a certain amount of money in a target date retirement fund every time you get paid. This ensures that you're steadily working towards your financial goals without having to think about it. This way, you're investing consistently without even having to think about it. By automating your investments, you can focus on your studies and other responsibilities, knowing that your financial future is being taken care of in the background. Chapter 4. The best investment: investing in yourself. You've probably heard the saying, knowledge is power. Well, in the world of investing, knowledge is also profit. The more you learn about investing, the better equipped you'll be to make informed decisions and grow your wealth over time. Think of it like this. You wouldn't show up for a final exam without studying, would you? Investing is no different. Luckily, there are tons of resources available to help you expand your investing knowledge. Start with the classics like The Intelligent Investor by Benjamin Graham, Warren Buffett's mentor, and Security Analysis by Benjamin Graham and David Dodd. These books provide a timeless framework for valuing businesses and making sound investment decisions. Don't be intimidated by their size. Take your time, highlight key takeaways, and revisit them as you gain more experience. But learning isn't just about reading books. It's also about connecting with people. Attend industry events, join investment clubs, and reach out to experienced investors for advice. You'll be surprised by how willing people are to share their knowledge and insights. Remember, networking is a two-way street. Be genuinely interested in what others have to say, and don't be afraid to ask questions. Chapter 5. Find your tribe, the power of community in investing. Investing can feel like a solitary pursuit, especially when you're just starting out. But it doesn't have to be that way. Surrounding yourself with like-minded individuals who share your passion for investing can make the journey more enjoyable and rewarding. Plus, you'll learn a ton from each other. Look for investment clubs or groups on campus or online. These communities provide a supportive environment to discuss investment ideas, share resources, and learn from each other's experiences. Don't be afraid to start your own group if you can't find one that fits your interests. Remember, the goal is to create a space where you feel comfortable asking questions, sharing your thoughts, and even disagreeing respectfully. Constructive debate is crucial for growth. When you're surrounded by people who challenge your assumptions and offer different perspectives, you're forced to think critically and refine your investment thesis. It's like having a personal board of advisors who can help you see the blind spots in your thinking. Just remember to keep it respectful and focus on learning from each other. That's it for my 5 tips for student investors. Remember, investing is a journey, not a destination. There will be ups and downs along the way, but by focusing on your why, understanding investor psychology, building a solid strategy, investing in your knowledge, and surrounding yourself with a supportive community, you'll be well on your way to achieving your financial goals. Thanks for hanging out with me today. Hit subscribe and drop a like if this video helped you. And don't stop here. Click on one of these videos to keep building your investing knowledge.